Hi and Assalamualaikum. Today we are from Group 7, Section 2, would like to present the result of business valuation for company Hi-K Consult. I'm Amani. Will give you an overview first on what we are going to talk about. The first is about business information followed by issue and critical aspect for business growth, computation of WACC, expansion project, business estimation, and last but not least, the forecast cash flow. So firstly, business information. Hi-K Consult was established in 2003 and incorporated on 7 August 2003. The managing director is Puan Khadijah Beti Awang and the company is located at Medan Mara, Kuala Lumpur. The company provides services such as account, taxation, and company secretarial to small and medium enterprises. Basically, this company is a business that provides professional services for accounting, taxation, and secretarial. They do consultation with the client and help them improve in that area. Hence, the Hi-K Consult gain their profit based on how many clients they serve and what services the client requests. For financial profile, the business started with an initial capital of 20,000 ringgit Malaysia, fully funded by the owner's equity, and it operates with no debt, which lower financial risk. The company generates a monthly revenue between 30,000 ringgit and 40,000 ringgit, while monthly expenses range from 25,000 ringgit to 35,000 ringgit. The business expects an annual growth rate of between 2% and 20%, depending on market conditions. The corporate tax rate is estimated to be between 5% and 70%, and all profits earned are retained and reinvested to support future growth.
Next, I will now explain the specific issues facing at Hi-K Consults regarding their margins. It consists of two things, which are rising operational costs and static fee structures. First, let's look at why Hi-K Consult operational costs are rising. It is becoming much more expensive to run the business. The company are facing higher labor costs and higher statutory contributions. To keep good people, the company have to pay more. Next, Hi-K Consults are also seeing higher expenses for software, cloud systems, and cybersecurity. They have to spend more just to keep their data safe and stay compliant with the law. Moreover, these costs are structural. This means it is very difficult to reduce them without hurting the quality of the company's work. As these expenses rise, it will reduce the company profit margins. At the same time, the money bring in is not growing. Their fee structures have stayed static. Even though inflation is making everything more expensive, Hi-K Consult have not really revised their fees. They are charging the same as they did years ago. Furthermore, stable pricing helps Hi-K Consult keep their clients, but it lowers the real revenue they make on every job. The company are doing the same amount of work for less real money. Therefore, this puts Hi-K Consult at risk of a long-term low margin trap. If Hi-K Consult don't make enough profit, the company won't have the money to reinvest in the company or come up with new innovative idea. In short, the bills are rising, but the fees are also stuck. This is a major challenge for Hi-K Consult's future growth. Thank you, and I'll pass to the next speaker.
Next, move on to the critical aspects for business growth. Firstly, Hi-K Consult enhances profit margins by leveraging automation and digital tools across bookkeeping, payroll, reporting, and advisory-related work. Improved server and cloud capacity allows routine processes to be automated, reducing processing time and errors. This enables employees to focus more on higher value services such as tax planning, financial analysis, which generate stronger margins and increase revenue per client. Secondly, the company reduces manual workload and optimizes operating costs through workflow efficiency improvements. With upgraded office equipment, daily operation becomes faster and smoother, allowing more work to be completed within the same time and resources. These efficiencies support sustainable pricing strategies and prevent long-term margin compression. Thirdly, Hi-K Consult implements its expansion plan through a server and cloud system upgrade with exabytes, involving an investment of approximately 132,000 ringgit. The upgraded system improves efficiency by allowing multiple users to access platforms simultaneously, minimizing downtime and system delays. These expansions support business growth, improves service delivery, enhances overall operational capacity. Finally, the company upgraded its office equipment with an investment of around 27,100 ringgit. New desktop monitors, networking devices, and presentation tools improve workflow, speed, and reliability. As a result, employees can work more efficiently, service quality is maintained, and the company is better positioned to support future growth while improving profit margins. Thank you.
Hi, I'm Faiz. So today I will explain about the computation of the VACC. Since Highcare Consult has a small startup capital of 20,000 ringgit, we choose not to use CAPA model as it is more suited for our largest companies. Instead, we use a proxy rate of 5.75% based on the current ASB dividend rates to represent our required rate of return, which is WACC. This rate is used as a standard benchmark to ensure our business returns are safe and realistic for the cost of the capital in the current market. Next, for expansion project. This slide shows the expansion project for Highcare Consult Sdn.Bhd. The purpose of this project is to upgrade the company's equipment to improve operational capacity. Through the expansion, the firm targets 5% increase in its client base and aims to reduce the cost of services by improving efficiency. The expansion focuses on digital and advisory consulting services, which require better technology and system to support daily operations. The total investment cost for this project is 159,100 ringgit. This cost is divided into two parts. First is the office equipment, which represents 20% of the total cost, amounting to 27,100 ringgit. This includes computer, CPUs, and router, and a projector. These upgrades help improve workflow and make operation faster and smoother. Second is the intangible asset, which accounts for 80%. This is a lifetime online data server, which allows more users to access the system at the same time and improve data management and system reliability. Overall, this expansion helps increase efficiency, support business growth, and improve service quality in the long run. So I will explain about the key assumptions. This slide explains the key assumption used in our analysis. First, we assume that the cost of service, specifically overtime costs, decreased by 20%. This reduction is due to increased employee efficiency after upgrading office equipment and system, which reduces the need for overtime work. Second, we assume a 5% annual increase in revenue. This increase is assumed because the company is expected to reach new market segments and attract more clients through improved digital and advisory services.
Next, forecasted cash flow for the expansion project. At year 0, the company makes an initial investment of 268,500, which include the office equipment, intangible asset, and an increase in net working capital. From year 1 to year 5, sales increase steadily due to 5% revenue growth assumption, while the cost of sales remain lower after the efficiency improvement. Operating costs include depreciation and amortization, and tax is calculated at 17%. After adding back the depreciation and amortization, the project generates positive net cash flow each year, increasing from 140,037 ringgit in year 1 to 181,293 ringgit in year 5. Overall, the forecast shows that the project is finally viable and generates increasing cash flow over time. Furthermore, we use discounted cash flow method for this project because it values the business based on its future cash flow. It also considers the time value of money by discounting future cash flow to their present value and takes business risk into account. Because of this, DCF provides a more reliable estimate of the true value of the business. For the key valuation result for the project, first, the internal rate of return measures the profitability of the project. It is the discount rate at which the net present value becomes zero, also known as the break-even return. For this project, the IRR is 43%, which is higher than WACC of 5.75%. This shows that the project is financially stable. Next, the net present value measures how much value the project adds today. All future cash inflow are discounted using the 5.75% of WACC and the initial investment is deducted. The project has a positive NPV of 376,945 ringgit, which means it's create value above the cost of capital. Therefore, the proposed project is approved.
Alright, to conclude this section, overall the digital and advisory consulting services expansion project is highly recommended and financially robust. Based on our financial evaluation, the project generates a net present value of 351 and 600 and an internal rate of return of 40%, which significantly exceeds the company's required rate of return or WACC of 5 and 75%. This clearly indicates that the project creates value for the company. Beyond the numbers, the transition from traditional consulting to a digitally integrated model addresses current operational limitations, particularly aging equipment, while also creating a scalable platform for future growth. The high IRR also provides a strong financial cushion, meaning that even if market conditions fluctuate, the project is still likely to remain profitable. Based on this, we propose three key recommendations. So for the first one, early cash flow generation. The company should leverage its existing long-term corporate relationships to secure early digital advisory contracts within the first 12 months. This will accelerate the payback period, reduce financial risk, and improve liquidity, allowing the firm to reinvest internally with greater confidence. Second, asset-light and cloud-first operations. We recommended prioritizing cloud-based accounting and secretarial software instead of investing heavily in localized hardware. This approach improves operating margins and keeps future capital expenditures low, which helps maintain a strong discounted cash flow valuation over time. Finally, risk mitigation through service diversification. The company should market its digital advisory services as bundled offerings alongside traditional tax and secretarial services. These diversifications help stabilize monthly cash inflows and reduce dependence on any single revenue stream. In summary, this project is not only financially viable, but also strategically aligned with long-term sustainability and growth. That's all from us. Thank you.